So anyway, let me show you how I make every model from a financial acquisition to just how I look to buy a stock as well. You know, what's amazing about this method is you really don't need anything other than Microsoft Excel. And if you don't have Microsoft Excel, you could always use Google Spreadsheets, which I believe is free. So in any event, we're going to do Tesla. And again, the goal here is to actually try and value the company. So I'm going to be using all publicly available tools. You know, the most important website is the SEC's website, which for a long time I actually had it as my homepage. You know, the SEC's website is really convenient. I actually had this page as my homepage, and it's actually not a bad homepage to have if you're really serious about this. And so the first thing I look at is all the 3 10Qs per year and the 10K. So for those of you who don't know what that is, these are quarterly statements filed by the company with the SEC, and the executives have to swear on them basically, or they can get in big trouble. So they have to be correct, and you can look up any company's ticker symbol and then look up their financials pretty easily. So where do we start here? So it's easy to look up kind of any company you'd like. And oh, I wanted to say that if this video and others like it will presuppose that you know a little bit about finance, and or maybe sometimes even a lot. And so if you're really truly a beginner, I'd say the best place you can go is Bill Ackman did this thing on something called the Floating University. And it was pretty cool because it was super basic. And so if you don't know anything about finance, you can do this. I'm not necessarily a fan of Bill Ackman, so don't mistake that for an endorsement of Bill Ackman. But I think the idea that you can, at least I think when I viewed this for a little while, he sort of explained what shares are and market cap and stuff like that. And I'll go through some of that quickly, but you know, I'm gonna assume you know some stuff. So looking up a stock price is pretty easy. You know, Yahoo Finance is perfectly fine. I know, you know, billionaires that use Yahoo Finance. You don't need fancy quotes. You don't even need real-time quotes really. So anyway, the stock price is about $208, which, you know, again, we won't obsess too much over that. And so we pull up the most recent 10Q. And what's kind of interesting is there's 2 places to get the number of shares, and these are the 6 things that you need to know about every company no matter what. And it's the 6 things that I kind of conceptualize anytime I think about any company, which is the price of the share, which is kind of arbitrary, right? You can have fewer shares and a higher price, or a lower price and more shares, and it kind of doesn't matter. But the next element is the shares. So the shares, you can see here, it's always going to be on the front page of the 10Q, which is kind of neat. We'll talk about that in a second, but as of July 30th, there are 127 million shares. So I'm just going to type in 127. If you really want to be perfect, you can type in the number of shares. And if you multiply the 2, you get the market cap, so to speak, of the company, which is every share, and the price per share means that all of the shares together are worth $26 billion. And we're going to do this all in millions, because that's what real ballers do, is we do things all in millions. And so anyway, this is $26 billion. So the whole of Tesla is worth $26 billion, which is a lot of money. But if you also think about it, that's kind of considered almost a large cap company. Not quite. It's, you know, not as big as a Facebook that's a $300 billion company, or something like that. So anyway, the next element is the balance sheet, which is, ironically, you know, at least in this 10Q, the first financial statement. There are 3 key financial statements. There's sometimes call them the Holy Trinity. It's the balance sheet, the income statement, and the cash flow statement. So we'll start with the balance sheet. And if you look at the first line of the balance sheet's ordered in liquidity, so it's assets and liabilities. So we're just going to take the cash. The cash is is important because it's basically your cash. If you own all the shares, you can actually just take out the cash as you please. As a private company owner, or a large owner of a private company, that certainly is the prerogative of the owner. So if you're a part owner, you don't get the same right, but you still sort of have that right. So I'm just going to do a little formatting here. So there's about $1 billion of cash sitting in Tesla. You know, I include these marketable securities. I'm going to include this restricted cash in a second. So let's see, it's 19,774. Okay, and now there's going to be some amount of debt, and you know, debt, you know, again, watch the Ackman thing, but that's not kind of what you think of when you think of like, you know, owing your credit card debt or something. Debt is a tool to fuel your business. So there's a little bit of debt here. There's a convert. When Tesla did this convert, I don't own any Tesla stock, by the way, or I'm short stock. I probably would. Anyway, we'll see. We'll see. In fact, I'll tell you what. After this exercise, I will put $1 million of my own money on Tesla, either for or against it, or if we determine that it's fairly valued, I won't make any investment. But we'll see what our exercise kind of yields, and this will be pretty complicated. Obviously, we're going to need a lot of time to make this decision, so maybe it'll take several videos. But anyway, I'll at least give you a start of kind of the way I look at it. So debt is about 2.6 billion. None of these other things, you can think of capital leases sort of as debt. Resale value guarantees, we'll look at that later. That sounds suspicious, could be debt. But either way, none of these are enough to kind of sway the fact that it's a $26 billion company. So if you subtract the cash and add the debt, which is the net cash in essence, it's really a $28 billion company, because if you did take this over, you'd actually technically be in $1.5 billion of debt to someone, which you kind of add to the value of the company. So that's kind of how we look at that enterprise value. And if anyone wants me to explain this anymore, I prefer that you probably look at the Ackman thing until you get it figured out. And yeah, you're welcome. And I will post this on YouTube or something. I don't know. So, and then I'll play League of Legends probably at some point. So, in any event, the shares outstanding is listed here again. That's 127 million. And there's other things in here that we'll deal with in a second that are pretty important. But that's kind of the very first thing I like to do, is just say, okay, what am I dealing with here? And you can do this for a $2 million company, right? You can do this for a $20 billion company or $400 billion company. It doesn't really matter. You can do it for a private company. You still need some element of the so-called capital structure, and this is an abridged kind of capital structure. So the way I build my models is I like to put notes on this front page that kind of are an overview. What does the company do? And I think we thankfully that's pretty easy for this kind of a company. We know what Tesla does, but there's sometimes details, like for example here you see that automotive revenue is roughly 90%, so we can see exactly how much, 92%, and then services are only 8%. So it really is a 92% of sales are automotive, and I assume that means cars, but it's just, you never know with these things. So I like to make notes just so I sort of have a fundamental understanding of the business. Maybe write the prices of the cars or something like that. But the real meat of it comes in this model, and so we're gonna make this model really, really quickly. And so, it'll be a little bit hard to understand, but that's life. And I'll certainly try if there are any questions to sort of guide you a little bit. Let's see if I can do it like this. Can you move the cam or the notes, please? No, actually. Oh, your face is blocking the notes section. Oh, okay, sorry. So that's the notes. It's pretty stupid for now, but they'll get complicated, and sorry, I'm just looking at all of your dumb comments. The notes are, the good thing about these models is you can save them, and I'll actually save this real quick, and I'll just save it to something, oops, wait, let me just, what I like to save it as is just TSLA is what I'll save it as later. I guess I can move the face. Yeah, that's probably better. Let's see, so we're gonna do this model really quickly, and we'll try to get an approximate value for Tesla shares. It's not gonna be, we're not gonna be able to do this that fast, but we'll give it a shot. So Q2 15, automotive, services, add the revenue, and so you can do this with Excel, you can do this with Google, you can do this with Google spreadsheets, And you can also even do this on graph paper. You know, I know the Warren Buffett method, and you can actually sort of do this with your own two hands if you really felt like it. So, 7. Okay, so, well, we should be doing this in millions, so I kind of, you know what, we can do it in thousands, that's fine. Thousands is significantly less baller, as I explained earlier. I don't like dealing in thousands. I'm just kidding around, of course. So, when am I gonna start playing CS:GO? Never. Okay, so that's Q2, and then, you know, it's nice I can just sort of copy and paste and pop in the Q2 14 numbers. 3, 6, 5, 4, 8. I can't believe I'm giving my secrets away to the world for free, but whatever. Okay, so I like to make a line here just to separate the how should I put this, the actual from the expected. So that's the actual, and the expected is coming. And forecasting is really about the future, as we all know, but and I'll show you kind of like the forecasting methods I like to use. But, you know, populating a couple of quarters isn't going to kill us. We'll do the balance sheet, we'll do all this stuff. So what are you all saying? Post the Excel in Google Docs. That's a great idea. I will do that. I will do that. Okay, so let me just finish this up. 46, 560, 48062. And you should never use the mouse with Excel. That's a basic. You know, if you can't do it without a mouse, if you need a mouse to do it, then you shouldn't be doing it. That's a OG kind of method. Okay, so now we got 2 quarters in there, and we can start to build the annuals, because annuals are going to be kind of what really drives it. And we're going to start a little bit of forecasting right now. Assume the share count stays the same, and I'll have a lot to say about that shortly. And, you know, we'll start to populate some basic kind of stuff like revenue growth. So it's always new divided by old -1 expressed as a percentage. See, Tesla grew revenue 24% year over year, and then 51% year over year the year prior. Gross margin is going to be low. It's a car company after all, but 22% gross margin. And then we'll go through kind of some other parts of, you know, what really is gross margin, because cash gross margin and reported GAAP gross margin are quite different beasts. So we're going to go to Tesla's website and do a little bit more. How many hours do you work a week? All of them. Why not write a program that does this automatically? That's a question I get a lot. It's a terrible idea. Don't do that. You know, that is a bad idea. You want to kind of understand what you're doing. It's important to sort of not try to shortcut it. And it's pretty fast, as you can see. It's not a lot of work. I mean, after 5 minutes, if you're already asking yourself, how do I automate this? You're probably in the wrong field. So let's look if we can find the Tesla investor relations site. And every company has an investor relations site somewhere, and this one appears extremely hard to find, but I think we can. There it is, ir.teslamotors.com. Sometimes I like to bookmark these, as well bookmark it because I might be coming back. And you want to look for press releases. Yes, you're just watching this guy work. Fucking asshole. What do I think of high frequency trading? I have a lot to say about that. We can discuss that. Um, what are we looking at? We're looking at me playing a video game called Microsoft Excel. It's a lot of fun. How do I calculate gross margin? It's just gross profit divided by revenue. So it's the kind of percentage of revenue that the company keeps. Again, you might want to watch the Ackman thing. But yeah, no, I'd be happy to discuss high frequency trading at some point. We'll read the press releases in a sec. Oh, actually, they do have the third quarter out. There's no 10Q available, but that's useful. This is a little annoying. Okay, so there's the income statement for, yeah, their earnings posted today. So the Q is not going to be out for a while, but that's okay. We can just, ooh, looks like they had a down sequential quarter. That's no bueno. But, you know, maybe that's their seasonality. So we'll look at that in a second. Sometimes it's normal for the summer to be slow for many businesses. It's even the case sometimes in pharma. And this is the way you should invest. You know, I don't think you can invest based on a gut feel or something like that. You got to do calculations, and it's painful. And no pain, no gain. You know, is sort of the words I live by. Because I think, you know, anyone who's selling you that you can just kind of look at it and figure it out really easily is bullshitting you. You know, that's not really the way it works. You need to do painstaking, kind of careful analysis, and even after you do the mathematical analysis, obviously you still need good intuition and instincts and all that. But you know, I'm a really sort of quantitative person in general, and it's really important to, in my opinion, to sort of do it like this. It's the only method that I know gives very consistent results that are, at least have been very positive for me. I think I made a typo. Let's see, I made a typo somewhere. Yeah, there it is. Okay. All right, so you can see revenue growth slowed for Tesla to 10%, which is really interesting thing here. Is the revenue was 51% revenue growth, then it was 24%, now it's 10%, and that's kind of curious, and maybe they have an explanation for that. Is this a new champion on League? How do you type so fast in Excel? Well, I'm a beast. So that's sort of how I do that. I like the candlesticks. Yeah, don't do technical analysis. That is a bad thing. You will not make money. Are we watching the stream inside your stream about your stream? Yes, that's exactly. Why is technical analysis bad? Because it doesn't work. It has there's no rational reason for it to work. And I'll explain that in a second. Quantitative analysis has changed the ability for technical analysis to work. So it's now shifted to quantitative analysis. So no, we're not competing with people with insider information. Okay, anyway, let's get back to work. Okay, so I got 3 quarters out of the 4, and there's going to be important metrics and things that we're going to have to look at and follow, and there's gap to non-gap corrections, and this is going to be a lot of revisions to this, but you know, first things first, let's get all the quarters in. And so we've got most of them, but let's go back to the press releases and find the Q4 14 press release, because it's sometimes easier to read from the press releases necessarily than the Q's and K's. Okay. All right, so this is a little frustrating because they have this weird shareholder letter thing that most companies don't have, but whatever. We found it. Okay. So here's their Q4 14, and not surprisingly, that is their big quarter. And they had no services revenue, which is kind of interesting because I guess that's a new business line for them, services revenue, which is really interesting, I think. Okay, so R&D, 139 plus 65, 196, 170. Interest income plus 219 minus 2873 minus 48, 3719. 125, 497. Okay. Q413. Q413. Someone wants to ask me if I'm dyslexic. I'll let you guys be the judge of that. Okay. All right. So what they say, confirmed revenue growth decline, 55% revenue growth, 51, 24, 10. 4 quarters in a row of declining revenue growth. So let's make a quick and dirty, and these forecasts aren't meant to be accurate, by the way. There's an accurate way to forecast them. This is not that way, but let's just assume they grow 10% per annum. And you can see the services revenue is growing a lot faster. So let's just break out the automotive growth versus the services growth, and let's just do that. So the automotive growth is really slow. Now it's only 7% growth, whereas the services are kind of growing on a different growth pattern. So let's assume the services grow a little bit differently. And then on the gross margin, let's assume there's 25% gross margin. And we'll just sort of leave that blank. And then on R&D, whatever, let's assume sort of 5% R&D growth and SG&A growth. And these are not meant to be these exhaustive good. These are really placeholders more than anything. Taxes, Tesla doesn't make money, so they have the fortunate situation where they don't have to pay taxes. And you can see even with substantial growth, they're still not quite going to be making money anytime soon. And so that's where the annual perspective comes in. Let's add one more to make Q416. We'll soon have a reasonable, I wouldn't say it's a good forecast, but just sort of a starting point for basic operations, which again, you need something like this to even begin the process of forecasting. That's fine. There's definitely a mistake here somewhere. Give me 1 second to find it. I see. Okay. Still a mistake here somewhere. Aha. Perfect. I think. Okay, cool. So let's sort of continue. Let's assume they grow 10% for a while. And let's go to the gross margin line again. This gross margin line is a little tricky because they have this bifurcated gross margin. And let's assume like gross margins pick up a little bit over time. So maybe they can get to 27%, which is a little unprecedented for a car maker, but we'll talk about how to forecast gross margins and think laterally about kind of what is it Tesla's really trying to accomplish, which is a tough, somewhat tough question to answer. And so let's make another line here. 2015. No, 2015 is not done, so put it there. And we can also make the 2014s. Okay, so within 10 minutes we've got a pretty I won't say intense model, but starting to get there. Forecasting interest income is a little tricky, so we're just going to zero it out for now, and I'll show you why. And then we're going to assume there's a tax rate when they get profitable of 25% or something, and then we'll assume a flat share count. So what is Tesla worth? So we're going to need a maturity for the cash flows after our forecast period, which will end in 2024 just arbitrarily. And let's say they grow 1% at maturity, which is a pretty egregious assumption because I typically don't like businesses that have any maturity. I don't like to assume any business can grow in perpetuity, which is kind of what the maturity aspect is. We need a discount rate, which we'll kind of arbitrarily assign for a second. And we can already arrive at a simple NPV. This is super simple, super simple, but it's still an NPV. So this is the moment of, this is sort of the judgment time, how should I put it? This is the important decision. So calculation yields a pretty interesting number of 4 billion. And so per share, that's only $33 a share. So and we're not ready to make a decision on this or anything yet, but basically, at least if Tesla grew revenue by 10% a year, which by the way is kind of what they're, if you look at it, it's actually what they're growing now. So it's almost generous to say that they'll keep growing at 10% a year. So if they grew at 10% a year forever and expanded margins quite a bit, from wildly negative to wildly positive, they would the stock would only be worth $33, and the stock right now is trading for $208. So that's a pretty massive short. And then so we got to think about, and I don't like, when I come up with these numbers, I don't say, oh my God, why are my numbers wrong? Let me start making my numbers higher. I don't think that's a realistic thing to do. I kind of try to ignore the number until I have a better forecast. For instance, my guess is Tesla is growing faster than 10% a year. They're capacity constrained. They probably will be coming out with some new cars, and people are, they possibly, when they have more capacity, they could be growing. So the models are good because they can sort of show you what you need to get, what kind of growth you need to get the current stock price. So let's assume they grow 20%, and that's for the next 8 years. They grow 20%. Then the stock's worth $156 a share, and that's a lot closer. That's a lot closer to 208. So that, in that case, I probably wouldn't short the stock because, that's kind of within a margin of error that's reasonable. And if they grew 25%, my guess is it would be a cheap stock, right? The stock, well, 236, it's not that much more than the current stock price, so probably not worth buying. But it depends on things like maturity rate. So if they grew 5% a year forever, which I don't think they could, and remember, I'm saying growing cash flow, which is an interesting concept. Then the stock is worth $400 a share, which is a double in the stock price. And if you judge the project to be less risky, like an 8% discount rate, and I'll try to explain what discount rate is in a second. Again, this is sort of an intermediate finance knowledge is assumed. Then the stock is more than a double. It could be a triple, $208 to $600. If you think it's a really risky project, then a 15% discount rate, negative maturity, it's easy to see, even with Tesla growing to a $27 billion company, and we're going to look up what Ford is doing in revenue and GM and stuff like that to see how realistic this is, and some other proxies. It's a little tricky to sort of see this being a good stock to buy. But because it's hard to grow 25% a year forever. Now there are companies that have done that, and it's not really a law of large numbers thing. That's not the right way to forecast. I see a lot of people make that kind of rookie mistake. They say, okay, well, they're growing 10% right now. That means they'll never grow faster than that. That's not realistic, right? There's lots of reasons why they could keep growing faster or slower, and we got to talk about that. So no, we'll talk about the revenue and cost of goods. The cost of goods is run through gross margin. So there's no actual cost of goods forecast, just the gross margin. Here's the gross margin. We have gross margin going up from 25 to 29, so huge gross margin expansion. So we built a basic infrastructure of a model. So this is more or less complete in terms of the income statement. We're going to do the balance sheet in a second, then the cash flow statement. But this is the income statement, and that's quite a bit. Why am I discounting net income and not cash flow? Well, net income and cash flow approximate each other over the long run, as depreciation and capex equal out. So we'll talk about that certainly. We'll talk about the batteries. Relax. Okay. So so we got the basic framework for a model, and I think this is not nearly enough, but it's important to say, this NPV, and then we gotta add the cash of the company and subtract the debt, or subtract the cash and add the debt. So we should do that just and dollarize it to the correct number of zeros. So that adds that, well, we're actually going to do it backwards. We're going to add the cash and subtract the debt to get the net present value. So it'll subtract about $1 billion from the solution. And in terms of discount rate and maturity rate, and we're going to do something even more complicated than that shortly. We'll go through all of that. But for now, that's where we'll kind of leave it. Let's go back to so this is sort of the first step for any company. It takes about half an hour, as you can see. And now the real work has to begin, right? We need to put real meaning into these numbers. These numbers are pretty much worthless, right? We have not done anything that requires even a brain to do. This is all really dumb work that it's just meant to set up a playing field. It's like setting up the pieces of a chessboard or Summoner's Rift. We just have a basic setup that we can now play with to sort of arrive at some more legitimate conclusions. So let's go back to the shareholder letter. Now we're going to actually do a little research and analysis. Okay, so when I read a press release, especially the 4 quarterly press releases are the most important press releases. So let me do this. Okay, so when I read a press release, I really try to read it carefully because there's only 4 of these a year that matter, right? The Q1, Q2, Q3, Q4 press releases, and everything else matters too, but these are really important. I always try to keep a lookout for the numbers. So if you see, because you can kind of put them in and try to forecast and keep track of some of these things. Autopilot released to 40,000 vehicles globally over the air. So I'm going to start putting in autopilot. And maybe we'll track autopilot, and we'll kind of see how to do that. They produced a record 13,000 vehicles. So production, we'll just call that production. Despite a 1-week shutdown. Okay, so what's cool about this production number is the vehicles number. And so what we can do is we can do something called ASP. And ASP is average selling price. So you can kind of do automotive sales divided by, and you should do automotive sales in dollars. So you multiply by 1,000, $852 million. And we divide that by the average selling price, or I'm sorry, the production number, which is they sold 13,000 cars for $850 million. So in essence, each car costs $65,000, and that's something that we want to monitor carefully as time goes on. So that ASP number is going to be really important because what we can do is we can actually start to forecast production instead of forecasting revenue growth blindly. And in fact, I'd like to do that right now. So 13,000 cars isn't a lot. I don't know how many cars are produced. We'll be looking that up in a second in the United States. But my guess is that number's perhaps even in the millions. So if you do 13,000 a quarter,
you know, you're doing 52,000 or so, right, a year. And so their market share has got to be really low. So they probably can increase their production as they increase their capacity quite a bit. And so what you can do is you can kind of hold ASP static, or you can forecast potentially ASP dropping. You could just do it as a luxury proxy. There's a few ways to do it. But anyway, if we assume ASPs are flat, you can actually kind of generate or look at automotive revenue through that lens. So if they just add 1,000 cars, right, 1,000 cars per quarter, you can start to think about what does revenue look like if you do that. You got to divide by 1,000 to get the right number, but that is kind of an interesting way to look at it because it will give you a better forecast in essence. And you want to look at these kind of like this. And, you know, this is I'm not trying to pat myself on the back here, but I do think this is a really, you're not going to get this level of, I think, analytical insight or I don't know of anyone that's sort of going through this with people. And I think this is I wouldn't say it's a secret or something, but it's certainly, I think, good for folks to see how you would do this if you worked at a big hedge fund or something. And I know a lot of hedge funds that they don't even apply this level of rigor. So so let's assume instead of putting these blind, stupid numbers on revenue growth, we're actually going to instead forecast ASP and forecast units. And nothing revolutionary here, but kind of an interesting, more interesting way to forecast automotive revenue than just taking flat percentage growths, which is a kind of a silly, as I said earlier, kind of a silly way to do it. Let's assume for a second, we'll know that these are not right numbers. Okay, so if we assume, maybe we can assume ASPs drop a little bit just because, you know, their cars aren't going to be super expensive forever, I don't think. Maybe not, I don't know. Maybe they drop by 4% a year, that could be fair. But the number of cars they produce will grow to 180,000 cars a year. And so if we do that, the revenue doesn't grow very much, as you can see. So, you know, that's going to be an interesting tell, and I'll show you why in a second. But we look back here and we see Tesla stock is only worth $26 if this is the scenario, which would be a big disappointment for Mr. Musk. But you know, we'll have to kind of keep working. We're not quite there yet. So let's see, deliveries, delive. Oh boy, it's late, or I'm tired. Deliveries, there we go. Okay, so Model 3 launching in late March 2016. So we can kind of put that here. Model 3 launch. Gigafactory, I'm going to put that on the front page. What the heck is a Gigafactory? I don't know. Model X, don't know what that is. So I'm just going to put this down here for further research. Maybe have one of my grunts research that. I don't know anything but pharmaceuticals. So. And so reading the press release, you kind of want to go through it carefully, but you also want to, all this stuff is a little bit hokey. I mean, you have to, vehicle electrification. I guess I understand what that is. And autonomous driving, we kind of all understand what that is. Introducing two groundbreaking new innovations. Model X is the SUV. Looks like the Model X is the SUV. Autopilot. I read an article about autopilot. It sounded pretty cool. Tesla energy products with a gigafactory. Power packs and power walls. Okay. And yeah, I now see what we're talking about with respect to the sum of the parts play. So we'll certainly work on the gigafactory in a second. And then we also should do the GAAP, non-GAAP translations. Those are really important, and that's where we'll kind of maybe take a break and look at the cash flow statement and stuff like that. Well, here's delivery guidance, so that's pretty cool. They're saying in Q4 we plan to build 15,000 to 17,000 vehicles. Okay, so we'll actually put in the number of 16,000 and deliver 18,000 vehicles, which will result in 50,000 for the year. Neat. Yeah, that's interesting. So we'll look at that in a second. But I kind of want to get the production and delivery numbers for the last couple quarters. So let's get that. And it looks like they kind of put it in the, yeah, they seem to put it in the same place every time. So let's see, deliveries of 11,532, record production of 12,807. That was Q2. Okay, Q1. Now Q1. Okay. 404, file not found. That's so strange. Probably hackers. Anyway, we'll work on that later. But there's sort of two interesting facts we want to build in here. Kind of what is, I don't know about global, maybe we'll do global, do worldwide auto production or deliveries, probably the same numbers. Oh, I have such a hard time spelling the word deliveries. And then US auto production deliveries, because we want to get a sense for kind of what kind of market share is this? And I imagine it's limited, right? I'm sure Toyota sells a lot of, delivers a lot more than, quite a, probably 100 times more as many autos as Tesla, which is the dream, right? Is that they can get to that level of market share. And that's, we're going to sort of just assess if that's realistic or not. So record quarterly deliveries of 10,045, 11,160. Okay, so let's go through the balance sheet because that's important. And I'm not going to Bill Ackman. I sent the Bill Ackman link to the Floating University. If you guys didn't get that, I think you should. If you don't know much about finance, then this is a really good place to go. I don't necessarily love Bill Ackman, but I still think you should watch that. So anyway, let's do the balance sheet real quick. Accounts receivable is money that the company is owed from its customers. Inventory is really interesting and important for a company like Tesla. It's not so important for a pharmaceutical company. I lump all the cash together, so if it's cash, and I put it all in there. So they have $6 billion in assets. Now let's do the liabilities. Well, we don't type that just yet. So accounts payable, accrued liabilities, deferred revenue. I typically don't break out long-term and short-term deferred revenues. I'm just gonna add that all up. Same thing with capital lease obligations. Resale value guarantees. I gotta learn something about this industry. I don't know what a resale value guarantee is, but probably it's a liability where they protect the price of the customer reselling the product or some shit like that. Okay, I think I got them all. Yes. And for shareholders' equity, I'll just do that. So everyone here should know that liabilities plus shareholder equity should equal assets, and that's why balance sheet balances. So the two numbers you can see are the same. L plus SE. Let's call it deposits. This is deferred revenue, accrued liabilities, accounts payable. Okay, so we've got the balance sheet starting to get populated here, and you might ask yourself, well, how do I look at a balance sheet? Oh, I'm very happy to tell you. There's a lot of things I look at. Net cash is, and this now you can see why I kind of just collapse all the cash in one and all the debt in the other. So the net cash position is important. They have negative $1.5 billion of cash. And you can actually forecast future net cash like this. You can see that their deficit, if you will grow. But eventually they'll hopefully start to produce cash and eventually maybe even have a positive cash balance. And why is that important? Well, it's actually because I like to do this thing called ROIC. So I assume that companies, capitalistic enterprises, take cash on their balance sheet and they actually invest it. And that's a really interesting concept because a lot of people don't model that. And that's actually, I think, the most important thing that people miss with respect to modeling, and we'll talk about that later. I probably need to extend the forecast period here a little bit. But anyway, so the balance sheet, net cash is one thing to look at. Accounts receivable is important as well. So DSO, day sales of outstanding, is basically how fast the company collects. And so you can kind of just do that real quickly like this. You can see in about 14 days, they have 14 days of receivables. Am I doing this right? Times, am I supposed to multiply it? Yes. So they have 13 days of receivables, which is very low, and that's interesting. It's because it's a consumer-facing business. They get paid right away, right? If you go to a grocery store, you can't say, well, invoice me. You know, you have to pay right away. But in our business, we actually we send drug, and we actually sometimes can take 30, 45 days to get paid for legal fees. I know that often takes quite a long time to get paid, especially if I'm your client. I take forever to pay my lawyers because I love them so much. Just kidding if any of you are listening. But yeah, 13 days is a really fast kind of number to get paid on. So you know, the PP&E is really important. It's not important for companies like Turing or Trophin or something, but it's actually a pretty important line for an industrial company. And you know, we'll talk about that in a second. So anyway, this is the Q2 balance sheet. So I got to move all this garbage over here. It's amazing to me, you know, this company loses $200 million a quarter and is worth so much because the promise of their potential future revenue is so high. But isn't that just like biotech, isn't it? So now you have the sort of format for this. So this is pretty easy to pop in the other quarters, and if you get adept, it becomes just as easy as it is for me now. Customer resale value guarantee. Okay, deposits. I guess they hold their customers' cash. Always a good thing when you can do that. That's called float. You can invest float, which is very nice. Okay, so those are two of the quarters of the balance sheets. Now we're going to look at the cash flow statement, which I know someone asked about. And this is going to be really fun. What's a cash flow statement? It's really complicated, actually. And so we're going to attempt to do it. So amazingly, the reported net income and the actual model net income are the same, but you can see here actually just really quickly, you can see that they reported $154 million loss, right, in Q1. That's easy to understand. Net loss, $154 million in Q1 2015, January 1st to March 31st. The cash flow was negative $131 million. So they lost $131 million of cash out of their bank, basically their bank accounts. Now, you might say as a novice, well, wait, that doesn't make any sense. So if they lost 154 million, why didn't they lose 154 million? And the answer to that's really complicated. It has to do with accounting. Accounting tries to measure, it's GAAP accounting especially, tries to measure, how do I put this so it's coherent? It tries to measure the economic reality of the business, whereas cash flow is literally just how much did the cash move from one side to the other. And if you know accounting, which I assume you do, which is not a fair assumption, you'll understand that there's accounting things that have nothing to do with cash, like stock-based compensation. You have to value the stock you give away to your employees, which you don't really know what it's worth. In fact, it's not knowable. By definition. So, but you still have to try to come up with a number and expense that number. And that's, not a cash item. So that's one reason why reported net income and actual cash flow will differ. And some of that is pretty technical. But, the good news here, I don't know if it's good news or bad news, but it's the news here is that at least that the cash flow from operations and the net income are somewhat similar. So, a lot of businesses, it's not the case. I'm assuming in Tesla that it's going to be really important to watch for a long time. And I'll talk about kind of other styles of analysis and how other people might look at a company like this and why I think it's an inferior method. And I won't name names, but I think some of you in finance may know the kinds of funds I'm talking about, and they're not exactly inferior too much. I mean, whatever works is a good idea, and there are ways to actually trade and make money. I'm not being 100% pejorative of traders. There are wonderful traders, and I'll try to work in kind of how do you actually trade, so to speak. I've always found myself to be a better investor than trader. I lose money when I try to trade, and I make money when I try to invest, typically. Not always, but I know a little bit about trading, and I can kind of try to show you. I'm not very good at it, but I can certainly articulate kind of what the point is of trading. Okay, so a lot of these are very tiny changes that are not going to be important, but to be complete, you might as well do it. Okay, so this sort of tells you what the cash flow changes are, and that's somewhat important, especially for a company like Tesla. So let's look up, so we did the, sort of the three balance sheet, income statement, etc. But let's look up. Let's go to Ford for a second, because that's going to be fun to sort of see what does Ford look like relative to Tesla, because Tesla's future might be Ford. On the other hand, Tesla's future could actually be something more like an Apple, where it's not so much it's sort of a new way to look at what they're doing. It's a luxury consumer good that kind of transcends what you thought about the good, and that's kind of what Apple did to the cell phone. So we got to think about that a little bit. But for traditional sake, let's look at Ford, and you can see Ford, their quarterly automotive revenue is $35 billion. So it's about 35 times the size of Tesla in terms of revenue, and I find it fascinating that their automotive revenue, Ford, actually grew faster, or just as fast, as Tesla's revenue, which is probably not a well-known thing, right? I mean, that kind of makes you wonder, right? It definitely would make me wonder if I was a Tesla shareholder. So why is Ford growing faster than my amazing company? And the answer is probably capacity, right? It's just that Tesla just can't make their cars fast enough. But if I just quickly mock kind of did what's the growth rate, oh, it's faster, but it's similar, right? 9% versus 7%, so it's a little faster. But you know, isn't Tesla supposed to be this super fast growing company? And meanwhile, Ford's revenue is higher. Just an observation. I know it's not apples to apples because of the capacity issues, but certainly interesting. I'm gonna try to eat this spring roll while I talk to all of you. And so finding the Ford investor relations may not be totally easy. Actually, there it is. And hopefully they talk about deliveries and stuff like that. Well, you can see that they're in the US, they're selling 200,000 vehicles a month. A little hard to annualize that. One way to do this is to just simply look at these monthly sales that they report. So October sales were 213,000, and that's a month in a month. So Ford's deliveries, 213,938 times 12, times 3, it should be 3 times 3. 3 months and a quarter. So, okay, so this is really interesting. So you've got Ford shipping 640,000 cars a quarter, while, and the revenue you've got there, which is 35 billion. And so you can actually calculate their ASP. And you can see that Tesla's shipping 13,000, which something seems off here. I don't think Ford is generating $50,000 of ASP. Oh, I think I know why, because this is just the US sales. So we need the global sales. So this is Ford's US deliveries, and that's Ford's global or worldwide revenue. That's why this isn't really adding up. So that makes sense. So it'd be nice to have just their US revenue, and that's actually in here. So now it's North America, so that's maybe not quite what we, well, that's income. We want revenue. Yeah. 23 billion. So that makes a little more sense, but obviously that's Americas would include South America. So not going to be, oh no, it wouldn't, just North America. So Mexico and Canada, and those aren't really real countries. So I'm kidding, of course, they're real countries. But. Okay, so that's a little more realistic. They're selling the average car for 36,000. We know it's not perfect, right? Because we know that we didn't really calculate the deliveries number. We didn't really separate out just the US, et cetera, but it gives you a proxy, which is what we're looking for in models, which is that, you know, you've got Ford delivering 500,000 or 600,000 cars a quarter, and you've got Tesla delivering a paltry, you know, 13,000. And, you know, objectively speaking, it's reasonable to think that if Tesla had the capacity, they could equal Ford's market share someday. And so Ford is actually, if you really want to look at it like this, they're doing 2.5 million cars a year. So the idea that someday Tesla will do 200,000 cars, that's really not a stretch, right? Because if you could see them doing it, and that's why Tesla looks so expensive. The reality is it might not be so expensive because you know, earlier, just to make a placeholder model, I was adding 1,000 deliveries or productions per quarter. Well, maybe I should be adding 5,000. Because what if they get their production online and they start to do 5,000 more per quarter? That's more realistic. Because again, right now, I mean, if I could, I don't even have a driver's license, but if I could buy a Tesla car, I would. The thing is so freaking cool. And you can see that over periods of time, you know, this whole idea that you should be doing these forecasts as kind of law of diminishing returns or law of what do you call it, law of larger numbers, that's not realistic because ultimately, um, what's driving the growth is not some numerical thing. It's really a more complex situation than that. So anyway, let's assume they can get to 30%, 20 or 30% of where Ford is today in 10 years. That's not so reasonable, right? I mean, that's not so unreasonable. I think that could work, and we'll look at proxies to sort of think about, well, why 20 or 30%? Let's imagine that that's what happens. And they have higher margins because they realize kind of slightly better efficiencies. We're all assuming that their ASPs drop quite a bit because they're only playing in the luxury market. So let's kind of assume they drop a little bit faster. So their ASPs start to look closer to Ford's. Maybe that's a little too fast. Say 5%. And they go downstream to the other folks. And let's say they're selling general administrative. That's going to grow a little faster than maybe we were forecasting. A lot faster, probably. So let's say that grows 15, 20% for a little while. And then eventually their production slows down. Okay, so what's the share price now? If they can get to 20 or 30% of where Ford is, and that's just for North America, right? That's assuming Tesla never can really crack the rest of the world. So this is really, you would argue on one hand it's conservative. On the other hand, right now they're such a small thing that they'd have to grow 10 times where they are now to get to what I'm talking about. But again, you can kind of close your eyes and realize that, imagine that, that's not so unreasonable given the amount of demand they have. So anyway, if that scenario happened, they got to 20 to 30% market share, not market share, but 20 to 30% of where Ford is. And Ford has about 7% market share globally. In the US, their market share is probably higher. So think about that scenario, and you see that the stock would be worth $250. And that is not a lot more than the current stock price, which is 208 or 220, as someone pointed out. It doesn't really matter. Obviously these numbers like the discount rate and the maturity, all these things matter a lot. And if you're really bullish on Tesla and you say, Martin, that's a slam dunk. There's no way that they do worse than that. I suppose you could make the discount rate lower. I don't like to do that. So you got to think about cost of capital, and this is extremely technical. And I actually think even if you try to learn it in school, you're not going to get a good understanding of how to use discount rates. It is something that takes a long period of time to really understand what you're trying to embody in discount rate and what it means. But let's try 7%, and now you get a $300 stock price, which is good. I mean, if you buy something for $200 and sell it for $300, you're pretty happy. But the discount rate, just changing it by 1% really dramatically changes it. And again, I'll someday give you all insights on how to look at discount rates. And obviously, maturity matters as well. If they can hold that market share forever, then that's pretty neat. If they can kind of grow it, they can grow it a little bit. That's reasonable. So, with a couple of reasonable adjustments, I think Musk does great investing work. I mean, what he's putting the capital into is pretty good. So you can get a double in Tesla stock pretty easily here if they continue to be hot and they continue to grow for the next 10 years. But that's a big, I don't know what's going to happen in 10 years. I don't know what's going to happen next week. So assuming that Tesla is going to stay hot forever, that seems like a tricky proposition. It's possible, certainly, that won't happen. And if that doesn't happen, the stock is not worth very much. So a little tricky and difficult to think through. So we've been at this for about an hour. We certainly don't have a decision. But what the model is good for is it helps frame expectations, right? You don't always go into this saying, okay, I'm going to crunch a bunch of numbers, and it's going to give me this, this number. And this number is going to be the be-all, end-all. That's the wrong approach, I think, to model. That's going to steer you in the wrong direction. I think a lot of people do that, and that's unwise. the model is meant to sort of be like a mirror. You're supposed to see a reflection in it and contemplate the universe. That's how these models work. They're a lot more cerebral and intensive tools than kind of trying to be just punching in numbers and seeing what comes out at the end. That's not the right way to use it. You have to use it to frame expectations like this. This model, this eventuality, this instance, if you want to use sort of a computing term, it contemplates a $27 billion revenue Tesla. Right now they're a $4 billion Tesla, so much bigger Tesla, but not, I mean, at this current rate of growth, remember the rate of growth right now is 10%, so at this rate of growth, they could never be that big of a Tesla. It would take too long. They really have to start growing again aggressively, like 100% growth or 40% growth. And right now they're growing at 10% growth, so this is a little bit of a silly view. But even with this silly view, you don't get much upside. I mean, I don't think it's that likely that they can grow. They're growing 10% now. Is it really that likely that they're going to jump to 100% or 50% growth? That seems a little foolish. One of the things I would monitor is the waiting list for the car, the demand, etc. But it seems a bit foolish to think that they could just jump from no growth right now or sub Ford's growth to some amazing growth level. I mean, that seems a little silly. And I would investigate this whole capacity thing. Are they really truly capacity constrained, or is it more of are they so capacity constrained that there have no capacity constraints that they would sell 20 billion? I don't know. There could be a way to quantify that, and I think we can go through that. But this is, again, the goal isn't to actually have a number. If you could solve a stock price number in an hour, you would be a really rich person. You go through hundreds of stocks and find the one that was really undervalued and buy it, and find the one that's really overvalued and short it. And that's why this isn't a 1-hour process. It's like a 100-hour process or longer. But this is sort of how I would get started. And from here, you have kind of a nice little framework to kind of do your work in, a nice little file, and you can take notes and stuff like that.